Yeah, so it showed that across the combined capital cities, home values increased by 0.5%, and most capital cities saw an increase. I guess the big point to make is Sydney and Melbourne are still outperforming the combined capital city figure, both recording a stronger level of growth both over the month, quarter and last 12 months than that headline figure. On an annual basis, home values are now up 7.5% across the combined capital cities, which is gradually creeping higher again. Certainly not as strong as it was 12 months ago, but still a fairly solid rate of growth, largely driven by Sydney and Melbourne. In terms of monetary policy, obviously, given where inflation is, typically you would see the Reserve Bank cutting, but they've cut twice this year on weak inflation numbers, and it hasn't really picked inflation back up. So what it has done is obviously given more juice to the housing market. So I think there'd be a reluctancy for a further interest rate cut, given what's happened in the housing market. In terms of what it means going forward with APRA, I mean, who really knows? But we know that the banks themselves are watching this space carefully, and we see every few weeks reports of a new list of places where banks won't lend or will really tighten their lending policies. And although we might not see as many releases about that, I'm sure behind the scenes the banks are doing that sort of thing and probably not telling us too much about it. So what the settlement risk report looks at is everything that's approved for construction in terms of new units and the time frame for when they're meant to actually be completed. So if everything that's approved and is meant to be built in the next 2 years is built, Brisbane will see an uplift of total unit stock of about 25%. It's about 49,000 new units. In Sydney and Melbourne, you're looking at about 90,000 new units, and that will increase the supply by around 15%, slightly more than that in Melbourne, slightly less than that in Sydney. So clearly, Brisbane has the biggest risk if all of that supply comes online in terms of how that's going to settle, particularly with tightening of lending policies to new units and to offshore investors. Melbourne too probably has a little bit more risk than Sydney, because I think in Sydney, for a lot of people, the unit market is the only way to enter into the market because housing prices are so high. But also the Sydney market has been approving more units than houses for 2 decades, whereas it's only really been the last 36 months in both Brisbane and Melbourne that we've seen that swing. You're not seeing as big a gap between house and unit prices in Sydney and Melbourne, in Brisbane and Melbourne rather. And I think that it's not quite as ingrained in the psyche of people in Brisbane and in Melbourne as it is in Sydney. So we're definitely concerned about the amount of stock coming up for settlement in Brisbane and in Melbourne, and in certain pockets of Sydney as well. But generally across the market, Sydney does seem to hold less risk. It's an interesting one. I think it could really go 2 ways, particularly if we look at it from an investor perspective. People in older unit stock may choose to move to newer unit stock where they can rent for a similar price, more amenities. They might have pools and on-site managers and gyms, whereas a lot of that older stock doesn't. Or the other thing we might actually see is people are going, well, these properties are too dense, I'm sharing with too many other people. And we may actually see a flood back to that older style walk-up stock, which is usually larger and doesn't have as many people living in the same building. So it's difficult to know exactly which way that will go. I think initially we might actually see a bit of a flight to the quality in the new, but I wonder if longer term we'll actually see a reversion back to those older walk-up style apartment blocks.